Hello, guys. It is September 2, 2022. And today I'm going to rant. No, I'm not going to rant. Thank you for watching the Global Market Update. I have a lot of things to share to you, a lot of stories and facts. So let me begin with a few slides here, as usual. I've always been fascinated about Ronald Reed. So in today's episode, September 2, I just wanted to give you more of a question. Who do you never bet against? And with these questions, you often will get a lot of answers. So for me, I just want to share that in my view, I never really want to bet against abnormal people because I've learned that everyone who succeeds has always been abnormal. Now, there are several ways to discuss abnormality, but maybe the words that other people describe these people as eccentric or different, alien, passionate, grit, whatever you call it, small edges will accrue over time. I wanted to share to you this abnormal, but people like to say it's ordinary, but I also think that it's ordinary and extraordinary. So, okay, I'm sorry, that's not Ronald Reagan. That is Ronald Reed, also known as the $8 million janitor, and how he accumulated that $8 million was frugally investing $300 per month for the last 65 years. A lot of people want to describe that as the power of compounding. But I think that what is abnormal here is that, number one, he did actually ascribe to the tenets of dividend income investing. So I want to share to you what I've done actually studying how dividend income portfolios have done over the last 40, 50 years. And what I actually thought about 2022. Beginning this year, I did also believe that dividend stocks would outperform. And it's probably worth noting in today's time, September, so 8 months after, what exactly happened towards these dividend aristocrats. Ronald Reed already died 7 years ago, 2015. So now it's 2022. I also like to study dead investors' portfolios. I figured that if it was really well crafted, there's always this theme by some of the greatest investors about buying and holding, hashtag never sell. I've often asked myself whether that hashtag never sell rule truly works. And to be fair, upon much investigation, the hashtag never sell rule still works, but you have to have a carefully selected portfolio. In fact, I would even tell you, and I tweeted this in my Faces Trader Twitter account. This is me. Thinking out loud, I do believe that I would never bet against an Elon Musk. I've learned time and time again that you seriously do not bet against people who already have proven the slimmest of odds. So, you know how it's very hard to make that impossible task of placing technology in electric vehicles, in artificial intelligence, in SpaceX. If you haven't watched the Netflix documentary about SpaceX and how hard it was for them to actually launch those rocket ships, and if on the third try they didn't actually successfully do it, their company would have died. I don't think there are several founders who even have the ability to risk that much billions for that mission, for multiracial planetary species, for SpaceX, and to actually try to solve the climate change through electric vehicles. A huge disruption that apparently since 1941 was never actually existed. So the hegemony of all the Toyotas and the car makers in the world was a monopoly because there was no such thing as a disruption towards internal combustion engines. So those are really amazing things if you really think about. I mean, think far from the charts. and think about the people who actually have discussed, and not just really discussed. I'm not really impressed with theory. I'm impressed with real people and real numbers. So I'm going to tell you who are the people that I've seen and proven business model cases towards long-term wealth creation. And I hope to share it, and hopefully you learn a thing or two. We learn a thing or two from them. So the first part that I'd share is the boring part. We go to the exciting part later on. I think that both boring and exciting are actually wonderful tenets in a portfolio that is a hashtag never sell portfolio. And to be fair, while everyone actually also teaches the merits of knowing that most innovative companies would fall 80%, 50% most of the time, that's the Mark Minervini rule. And I did prove from actually so many examples as well by studying data that is also true from a year-on-year perspective, or even a few years, multi-year perspective. Um, you have to understand that the retracements of other companies aren't going to be 80%. So some companies will never hit a 10x within about 5 years or 10 years. That's why they will never retrace that bad either. That's what dividend income portfolios are. The hashtag never sell rule actually applies very, very well with a dividend income portfolio. Because consider this: for Ronald Reed, $300 per month, 65 years, his total capital invested was about $234,000. How did it become $8 million? Well, he passed away 92 years old. That means that he had a 65-year compounded growth, which he really never sold a single share from. Number one, I think that is abnormal. Most people avoid pain. They avoid the pain when they see 100% return go down 70% return, or even 40% return, or even a 20% return. In fact, most people I know would take profits 20%, 30%, 50%, and the 100%, sometimes they let it go, and that's their moonshot play for a 5x, 10x move. I think that's well and good. They still practice the hashtag never sell rule on the latter part of their investment. And that's really what Motley Fools also successfully shared in their life experiences. Motley Fools, for those who aren't aware, is the Gardner brothers. So although they never really discuss how big their net worths are, but I would assume that they started with meager thousands. And this has nothing to do with their subscription business, which is very successful as well with the millions of subscribers. What I'm impressed really was their hashtag winners win. They had that commandment, which I also be really adopted for myself. Um, I really learned that winners win is not simply an investing concept. It is really true whenever you see people, not just about athletes like Serena Williams, or or seeing Tiger Woods. It's not really about those people. It's not just really a field. Hashtag winners win is a simple momentum concept. It is what most TA or technical analysts believe. A trend follower believes in the following: a stock price going 5x, 10x, 100x, or 1000x with zero sell signals, simply because they never sell until their rules say so. I mean, if you really look on I guess on a long-term chart of Tesla, one person that you could never really one person or one company that you would never really go against is a Tesla. You never want to bet against this super long-term trend. I mean, it's a mega trend, obviously. A 50% drop, that is what Mark Minervini talks about. But then again, that was a retracement from 400 to 200 and is now back in the groove with an uptrend yet again. Had you sold any time here before that 33x run over the last 3 years from 2019 to 2021, Even until today, I am still surprised how a stock can move 33x. No matter how great the company is, you try to think, wow, your $1 is $33 in 3 years. I don't even think that Bitcoin actually managed to outperform that. Bitcoin went from 5K to 70,000. That's still a 14x move. But I couldn't really say, well, that company, what did it change? Sure, it changed the world into decentralization, to think about the theory of money and how money actually works, on whether we should control it rather than the Fed raising rates or printing money for us. But I really, I mean, you may think that this is just more of a topic of rant, but these reflections come from a lot of evidences. So I guess I should say this with a lot of ideas. So the Psychology of Money was a book, obviously by Morgan Housel. In his book, he talked about the $8 million janitor, and I discussed about this several times in the Awesome 10x members as a foundational strategy. You can watch a lot of summaries about it, and I wouldn't go on to say that. But for Morgan Housel, what he always said was what he learned from Ronald Reed's story is doing well with money has little to do with how smart you are, but how you behave. All of them discussed mainly the importance for room of error. Ronald Reed, over that 65-year span, actually had 95 stocks. And I'm not saying that you have to have 95 stocks, but over the course of 65 years of investing, I would say that 95 stocks was a result of him plowing another $300 every month to buy a new company and so on. So he really had the epitome of that diversification play, but he wasn't really diversified. When I analyzed his positions, Ronald Reed was really more of an ETF. Um, a lot of people like to credit Ronald Reed's success towards the power of compounding. You look at this, wherein on day one, if you had 1 centavo and you doubled every day, how much would you have after 30 days? That 1 cent comes out to be a little over $5 million. But I think that no person can actually compound his wealth double in a few days, let alone a few years. So in a lifetime, say of about 90 years old, and that's already wow for a person to live. He basically had 6 decades of compounding. So his one went to two, two went to four, four went to eight, eight to 16, 16 to 32. So for $250,000 times 32, that was the 7.5 to $8 million he ended up with. And this is why Charlie Munger and Warren Buffett talked about their winning combination. They said, my time frame is forever, hashtag never sell, hashtag winners win. And Charlie Munger was often quoted that the first rule of compounding is to never interrupt it unnecessarily. A lot of things were discussed about the snowball effect. A lot of people who studied Warren Buffett's life, even until today, and even after he passes away someday in the future. He, of course, just had his birthday on August 30, 31, I believe. So just a few days ago, 92 years old. Um, to me, no, a lot of people likes to give credit that Warren Buffett's great wealth came from compounding. How many people actually would consistently invest every month, every quarter, no matter the headlines? I think that most people don't. In fact, I'm going to share to you this visualization that really helped me, you know, consistency versus intensity. What was that? Where did I make it? I think, where did I put that? I teach a lot that sometimes I can't even remember which slide that was, but I can find it here. I think I got it from visualizations. Consistency versus intensity. Do I have that picture? Hmm. Wait up. Visualize value. I think that's where I got it. Yeah, from here. Visualize value. I love this chart. I love how they simplify a lot of great concepts in just one picture. Um, I saw a picture about consistency and intensity, and I shared it, to be fair. So, this is the compounding, how distraction and focus actually is. Um, hmm, it must have been a very old tweet. I can't even find it here. Wait up. All things are difficult, but they are also easy over time. Mm, let me just look it up in my feed. I shared it here. Consistency versus intensity. So what I find surprising is that most people think that they can actually be consistent. But my experience with most people, and even with myself, is that most people are not consistent. I mean, if we were consistent, then the whole world would have been thin and there were no diabetics or obese people in the world. That just doesn't happen. Consistency is very hard to really achieve unless you automate it. That's what I've really learned. In fact, I know that the reason why people most of the time have gone wealthy through real estate has nothing to do with real estate going up faster than the stock market. That's really untrue. It's just really a function of forced savings. Number one, you cannot sell your house. So that's a hashtag never sell immediately. Okay, this one, intensity versus consistency. So a lot of people credit Ronald Reed's great $8 million based on his consistency of deploying $300 a month. And a lot of people often discuss the power of compounding because the SPY or the S&P 500 has been proven to return 11% CAGR over the last 100 years. So basically, if you just simply park your money, 11% return is very, very fast because over a 10-year time span, you would have doubled your money. I.e., if you had $1,000, it would have gone $2,000 left alone as long as you were just cost averaging, whether it be $300 a month or $1,000. And that's the average. Obviously, if you are investing in weaker times or recessionary times, you'd have gone more than 11%. It could be 15%. You could have gotten a 20% CAGR. And every percentage of that CAGR counts, by the way. So there's often a lot of questions about timing the market versus time in the market. And what the consistent cost averaging people have done was if I chop up my entire monthly into a 25% towards the market, no matter if it's rainy or sunny, September, they're saying it's a Halloween, there's like a seasonal indicator for September, seasonally being down. You think about it, well, there are several proofs that yes, you can tweak sometimes, but how much can you really outperform an 11% CAGR that is happening year in, year out? Because of that great return, which is very simple, John Bogle of Vanguard, who already passed away, amassed a $4 trillion asset being managed, which is really just an S&P 500 mirror. It's an index fund investing cohort. He was a prime believer of every American being rich simply by being consistent and cost averaging the S&P 500 every quarter, every month or every quarter, whatever they prefer, which led to the 401k movement, led to the FIRE movement. FIRE is like financial independence, retire early. I like to share these concepts because I really believe that I don't think, in my personal experience, that people would be very wealthy if I teach them how to trade. Yes, I would say that there is a lot of alpha determining when to go intense mode and when to go. Intense mode means that you are investing more in times like these because obviously there are great bargains that are to be had. Taking advantage of crisis, that's the intensity part. But at the same time, I also believe that true wealth creation has nothing to do with people who can even do stock selection or timing the market. A lot of it has to it, and it all boils down, and these come from traders with a lot of experience, not even somebody like me, um, who have proven through their own experiences that it's always about risk control, time, and how they manage risk control is a function of just tranching it out through time. So even the greatest traders in the world also believe in tranching and buying zones over multiple levels over time, multiple prices, multiple levels. Everyone discusses asset allocation, i.e., how much cash versus stocks versus bonds versus properties, which gives you that pizza pie rule I often call, if you've ever heard me talk about the pizza pie rule. But it's really asset allocation at the end of the day. Time, risk control, and the main concept was always about um, yeah, just being consistently averaging your position in high quality names. And if you don't know what high quality name was, everyone would just say, all right, just get the SPY because the market's enough to give you your stock selection idea. Why do I share these things? Okay, people like to say that it's easy, but it's and I'll want you to listen to this. This is a CNBC 4 minute about
what does it take to amass Mr. Reed's $8 million fortune?
Okay, let's try to listen to that part. When they learned that Ronald Reed had basically $8 million in his safe deposit box. He was investing for 65 years, and 65 years ago, there were no online stock certificates. So he had all those stock certificates in his deposit box. Let's share that story for you. This janitor made $8 million investing in household names.
You know, there's a story I love I talk about all the time. It's the story of Ronald Read. He's a humble JCPenney janitor. He lived frugally, and he took all of his extra money, and all he did was buy stocks of household names. When he passed away at 92 years old, he had $8 million that he left behind, and he gave most of it to charity. Now, some of the stocks he invested in, American Express, Johnson & Johnson, Procter & Gamble, all are up this year. And I particularly wanted to highlight Reed's investment in McCormick. It's up 43% this year. Boring McCormick. I got to tell you, Reed, in my mind, it's a perfect example of that you don't necessarily need to buy Amazon or Apple to be a successful investor. Sometimes it's just the stuff around you. So is that what people should be doing now? Joining me now to discuss, John Lonsky, Moody's chief economist, Keith Fitzgerald, Money Map Press chief investment strategist, and Paul Schatz, president of Heritage Capital. Hey, Paul, it's been a while. Let me start.
Yeah, well, they talked about Ronald Reed investing in household names. It's like the Peter Lynch rule, right? Peter Lynch said, buy something that you know. For those who aren't aware of who Peter Lynch was, he's a very successful Vanguard manager that also amassed consecutive returns for many Americans in his lifetime. What did I learn from all of them? Here's what I learned, and I'm gonna share this to you. I shared it in a class. All of them actually succeeded. Ronald Reed succeeded because he basically invested in dividend stocks. So these are dividend aristocrats. When you call an aristocrat, any aristocrat means that they have been paying cash dividend for over 20 years to be an aristocrat. And because you were consistently paying a dividend and raising those dividends over 20 years, you become part of a special community, because not every company can manage to raise their dividends every year consecutively for more than 20 years. That because of that unique criteria, there was an ETF that actually was created, an exchange traded fund, specifically for that passive investment but highly respected business strategy, which is you earn a lifetime of passive income simply from dividend stocks. Okay, in case you really want to know this, studying this, of course, forced me to learn that if I wanted to earn, say, $10,000, if I just make money while sleeping, on average, these dividend aristocrats would only give you about 4% dividend yield. So that means that just to earn $10,000 a year, I would have to have a $250,000. So it would take money just to make money. So most people can't really afford to have $250,000 immediately. Ronald Read took 65 years just to have $250,000 of capital actually invested from his salary. Obviously, it was the dividends that were compounding year in, year out that actually made him net that $8 million. And if I would actually look at Ronald Reed's portfolio today, I could easily assume that his portfolio today is more than $15 million. He would have doubled in the last 7 years, if not tripled, and continue to earn about $40,000 every month now. Because at least 3% of a roughly $15 million would have given him $480K per year. So a lot of people would say that the dividend income portfolio is classic Berkshire Hathaway. And it's timely to talk about these even on the September. Because look at all the top stock holdings of Buffett, even if you just try to look back over the past. Since Buffett is a prime believer of my time frame is forever and I never sell, diba? That's how Buffett really believes how stocks are. So, of course, his Apple managed to really beat the market this year, even in a tough year. His Coca-Cola is still managing to trade near all-time highs. Bank of America is volatile. This year, American Express is volatile. Kraft Heinz is volatile, but actually not as volatile as you'd think. So let me go towards those charts. 2022, Apple actually has been sideways, right? So it went down from 176 almost as low as 130, and now it's 157. Now, obviously, if you just look at the year, that would be a lot of volatility. But if your time frame is forever, probably you're looking at the fact that, well, for Buffett, he bought quite late. You could argue it was late. Here at about $18. But $18 at 160, it's really just a blip, right? He owns Kraft Heinz, and I think he lost money on Kraft Heinz. He said over time that this was one of his losers that he eventually had to sell. So he still has this loser, Kraft Heinz. He owns Bank of America. So we know that he owned a lot of Bank of America around 2008. Here, around 2008, during the crisis, he bought a lot, I believe at about $7 or $8. Of course, Buffett today has a lot of Chevron and Occidental, and he's been adding and getting an acquired a stake of 50%, one of his last major big buys of a company before perhaps he passes away, because he's, of course, past 92 years old now. He just celebrated 92. But one thing that we can say is that his bet on Occidental Petroleum is nothing more than dividends and free cash flows. Since Occidental Petroleum is in a buyback spree, most of the oil companies in general are trading with about 25% free cash flow yield. And Chevron, all of these have been paying a portion of that in dividends. And that's really what a dividend income investor is all about. Do you pay cash dividends year in, year out? And these companies have been doing that. You can know that simply by going to the daily chart. You can see that they've paid dividends no matter what. And although in 2020, Chevron actually stopped, well, they didn't stop paying dividend, but it was lowered. But the fact is, they paid dividend consistently, as I said, over the last more than 20 years of existence. For Chevron, that's like 1969 towards 2021. That's like older than me. How many years has that passed by? 50 years? So let's analyze a few things on why Ronald Reed made money. And the answer is not just time. It was all about the dividends. Dividends that continue to give him cash dividends. And he just compounded all those dividends. Since he never sold, these companies paid him dividends and he simply reinvested those dividends, netting that power of compounding. So I looked, yes, he owns a lot of Johnson and Johnson drugs. For most dividend club owners, they would tout the companies like AT&T, and Ronald Reed has that. You can imagine 65 years. J&J, he had that. He didn't invest in any tech company, so he had zero Microsoft, zero Apple. During his time, there wasn't Starbucks. Starbucks was only 1997. So he doesn't have that either. I didn't see him owning I don't know if he owns cigarette companies, but for the life of me, this is how much you would have earned annually if you did actually have $1,000. Sorry, this would have been today's thousands of dollars that you would have needed if you wanted to simply earn $1,000 in dividends. So Visa, MasterCard, and Apple, those are hard to get companies because Apple, you need what? Less than $200,000 just to get a thousand. So I would say that for the reality and practical people like us, if you really want to build a dividend income portfolio, you would have to majority bet a lot of energy names. And that's really what we were also discussing this year. Why we felt that XLE and XLF were actually gonna outperform, no? Because in the playbook that I've crafted since 2022, January, basically usually New Year, you think a lot, you go introspect, you had your Christmas, then you think a lot. So in 2022, I was thinking, well, the market's gonna tank and the world will actually try to be in dividend names. So energy, financials, and utilities were my plans of which companies would outperform. Unlike Ronald Reed's time, you did have to individually invest in which XLE companies, which XLU companies, which XLFs. Nowadays, we can just do away with just owning the ETFs. So XLE represents your energy. That would have fared very fine. You can see that from January, from 56, it's now 78. So that would give you what? A 40% return. Your XLU, which are your utilities, your next era energies, your utility companies this year would have fared you a flat return from about January 2022. It was somewhere here, about 69, and now it's about 75. So you'd have gotten the dividends plus that 10% appreciation. XLF, which is your financials. If you strictly looked at financials, for 2022, you would have lost some money. 41 went to 33. So you'd have lost some money out there. But banks in general, such as, let's say, JP Morgan, would have given you something like a dividend of around 3 to 5%. So here, $1, $1, $1. So about $3. I would assume that if your cost was, say, 2020, then you would have lost, no? So your cost would have been $160. $3 over 160 would have netted you a 2% yield, but a loss of about more than 40%. Then again, the dividend investors wouldn't have just had a cost of $160 for JPM. I would surmise that if they were Ronald Reed doing their cost averaging, then over the last 15 years or over the last 50 years, they would have amassed more of this average, right? So they would have maybe an average of about $100. It would have been less than $100 in my assumptions. So What are these lessons that we are learning from people who have made it? Let's go through some facts, even if these are either you just need the facts or you don't need the facts. But, well, if you invested $10,000 in PNG roughly 10 years ago, and I'm using mostly 2021, 2022 numbers here, you would still have tripled your money from a capital appreciation. You'd have earned some dividends on every year, a 7% yield on your cost. That's not bad. If you invested in Colgate Palmolive, it was worse. You would have just doubled your money. You would have gotten your dividends and a 4% yield on cost. Nike, this year was bad for Nike. Flat retail sales, obviously a consumer spending recession. But I've always learned that buying Nike quarterly would have netted you great dividends. You would have bought a Nike shoe every year for free had you done this at least 3 years. At least 3 years. So if you've been investing every year, every quarter, you would have chopped up a good average cost on your Nike, and this would have still resulted for you. Now you might say, but these results came from 10 years ago where the Fed was actually printing money and you had interest rate lowering, you had quantitative easing, and the next 10 years might not be the same. Well, to be fair, quantitative tightening is not, I think, a 10-year program. And I don't think that you will rate hike for the next 10 years. So whether we rate hike for another year or so or another 2 years, I wouldn't bet on the fact, and that's one thing that I would never bet against. I would never bet against America basically killing their own capitalism, since greed has allowed America to be what it is today. Money flows in America simply because of companies having access to liquidity. So if you are a Nike or you are an Apple or you are these companies on the dividend club, you would not really have a problem on interest rate hikes, because Warren Buffett would have told you that great companies invest in a crisis, have that high margin to insulate them no matter if there's inflation. And that's really what happened. When you say you're a dividend company, you would have grown your earnings per share, and a function of your earnings, sometimes 20% of that or sometimes 50% of that, was simply released and returned to shareholders. Something that all oil companies are doing today, and also something that all shipping related companies are doing today. That's why there are energy income funds, there are companies in the shipping related sector that's doing the same. Sometimes as weird as paying a 50% yield. 50, yes, you got me. You heard me right. 50% yields. So McDonald's would have done the same. So McDonald's is your usual dividend play. Pfizer, Bank of America, Kimberly-Clark, Caterpillar. Let's show to you what Ronald Read invested upon. Did I put it here? Okay, I tweeted it. Ronald Read had a lot of P&G, Raytheon, John Deere. He did had a lot of also energy names. He had AT&T, telecoms. He did have that. He had Wells Fargo, Colgate Palmolive, American Express, James Smucker, Johnson & Johnson. Let me show to you the charts of these companies. James Smucker is a peanut butter and jam company. Okay. If you really look through the last 60 years, 1969 till about 2020s, well, I don't know what Ronald Reed's costs were, but if he was just cost averaging over time, then we can just use this 50-month average, right? So if he was just cost averaging all throughout, he would have probably 50 months. I'm not even sure if I should use 50 months. Perhaps that may be way too much. 50 months would result into at least 5 years of average. But let's assume his average price would have been here. So if you've been doing cost averaging on James Smucker, then your cost would be here at 115. If you had been doing it more than 50 months, then probably your cost is somewhere here at about $30. I share these charts because it is an underappreciated fact. Yes, everyone knows that with consistent cost averaging and discipline, you would amass that $8 million, $10 million fortune. And at the same time, these are household names. These are companies that everybody uses, right? So this one was $1, went to $170. What's the story then? Is it all about just investing in a playbook of financials, utilities, etc.? I mean, in 2022, I said investing in energy, financials, and utilities would pay off. Probably growth stocks could bounce, but limited to a rally, and then it will get shorted. I was right about that. It did get shorted. Mega caps are extended, could continue to remain extended. They were extended, they fell, but they are still extended until now, actually. It's not as if they fell much. Cryptocurrencies peaked, that's true. They can fall 50, 95%. That happened, and that is true. They fell 70%. Some tanked 95%. Weak earnings on tech, that was a short, that was true as well. But these are the timing related items, right? And possible to remain bearish until 7 months. It's already September, so being bearish is not vogue anymore after the market's already fallen. I would say that what surprised me has nothing to do with the forecasts being accurate, but really about executing that knowledge. Well, executing that knowledge of knowing that dividend yields would pay off. What happened this year towards a JPM, of Valero, and a J&J? Obviously, this year, it was mostly the energy stocks that really went up heavily, right? So this was your 2022. January here, 2022, you have gotten Valero 72. It's now 110. It rose as high as 140. You would have had a 100% return on Valero. You would have had J&J consistently just churning out those dividends this year, even if you're just looking at a 1-year format. But of course, these winners kept on winning. These were the hashtag winners win tandem, right? JPM would have fallen this year. This year was a bad year for the banks, but it would just have been in the average, right? If you've been investing in a 5-year average, you still got your gains. At worst, you probably were just break even this year, even in that drop. Those are interesting insights to know. And one thing that is great is when you are a dividend income investor, this is true. Some people who simply own a Nike and AT&T and McDonald's would get dividends every month. Since Nike pays quarterly, 1% if you bought, well, at 133, and now you can just buy Nike at about $100. AT&T right now is about $18 after they spun off Warner Brothers Discovery as a free property dividend. McDonald's today is more expensive at about $250. So, and of course, they continue to pay dividends. These are dividend aristocrats. Now, what would have happened if you invested in growth names? We saw that growth names as a whole fell 70, 80%. Some of them were able to stand their ground, but most of them fell. So Airbnb this year fell 60%, Shopify fell 80%, Sea Limited fell 80%, Tesla went down 50%, now closing at a gap of about down 20, 30%. They rallied back. Palantir is still down 80%. Solar names managed to go up. Your EV-related names are downhill. Your additive manufacturing is downhill. ChargePoint, depending on your entries, you would have gotten a big gain or you would have gotten a loss depending on your entry points. QuantumScape also would have given you a big gain or a big loss, again, depending on your entry points. Desktop Metal is down massively, about 80%, I believe, from its peak. Beyond Meat fell 80% from its peak. NVIDIA fell about more than 50, 60% from its peak. But of course, these are all just 1 to 2 year drops, just from 2021 peaks. So I had a view that wafer was gonna fall. Indeed, from about $200, it fell to about $50. I had a view that Lucid was gonna fall 38. It's now what, $16, and I'm still bearish on Lucid. Neo is now down to $20. You want to short the department stores, air travel. Well, during that time, because Airbnb used to be trading at $170, Coinbase used to trade at $250, you would definitely short it, even in January. And Coinbase went as low as $40, $70, right? Solar Edge, this would have been wrong because after, I mean, temporarily, right, 280 went to about 200 and then rallied back up. Xpeng would have been right. Freyr went up 14, went down to 6. There's a lot of volatility in growth names, right? Melly today is trading at about $800, fell to as low as $700, $600 around the first half of the year. Shopify fell all the way to about $300. So Shopify had a magnitude 80% drop, which makes it really underloved and totally oversold. It's just good to look back on ideas and how it played out. A lot of things were actually right. It's just a matter of execution. Now, looking back, I'm thinking out loud today. So, after all this rant, what will you not bet against? No, if you believe that the hashtag never sell is true, and if you believe that the dividend income stocks are true, what about growth names? What about growth names? Do they follow this compounding snowball effect rules? Do they follow that consistent compounding rules? It's not about it's about time in the market, not timing. Are these companies like Tesla, Amazon, Nasdaq, Bitcoin, are they to be bought? Will you do your awesome 10x move over the next 10 years with growth stocks or a combination of dividend names? What will you do with it? Okay, a lot of people, I think, are better off learning from those who have learned that if you do save enough, there is such a thing as recession-proof stocks. It has been proven. So what happened to these recession-proof stocks? Johnson & Johnson, Procter & Gamble, Walmart, Coca-Cola, AT&T, some oil names, all the recession-proof stocks proved their merit. Not just about 50 years ago, they proved it this year as well. Now, for the next 10 years, however, you will also often tell yourself, you don't want to bet against an Elon Musk. I don't think anyone who bet against Elon Musk ever won on a long-term span. Your $1,000 invested in 2011 in Verizon would have gone 1.5, P&G would have gone 1.8, but investing in the tech, like the FANGs, Microsoft would have made 10x, Google 10x, Visa 10x, and Tesla would have made your $70,000 to $7 million. Even until today, it would have been growing and strong. That tells you the big tech is not to be bet against. They are not to be bet against. So whenever people ask me, what will you do on the FANGs? Are you going to buy some FANGs now? My answer is, I never bet against Mark Zuckerberg. Meta, I bought in at $160, 161, 162. I got into some Google at 110. Maybe it falls 105. Disney pays a lot. Disney is a dividend name as well, high quality name. Now, do I care if Tesla and Palantir don't pay dividends? A part of me thinks, why am I investing in Palantir? You may not know why. Well, of course, I did do my digging. At the core of it all, my investment in Palantir, and I really have it in my long-term port, and I do have also some C Limited and Zooms and Square, aka Block. It's not just about secular trend investing, and there's a lot of proofs as well that secular trend investing works. It's not simply about believing that e-commerce is the future, that Amazon's continue to grow, la la la. It's not. I think at the core of it all, I said this in some reflections. Charts are overrated. Fundamental metrics on a quarter basis is overrated. These are all cookie cutter metrics. It has nothing to do with the next decade. If you've invested in Google in 2005, you would have known that it was such a great company, but you would have underestimated what Alphabet today manages to make every year. When Eric Schmidt bought YouTube, do you really think he knew for $1 billion that he'd make at least 40 billion earnings every single year? He wouldn't have known that. Maybe he had an inkling, but he probably didn't know just how strong the business was. And so what I'm saying here is that my personal realization, what have I learned from people who are very successful? Well, I believe in the Palantir Pack. The Palantir Pack today got an article and I shared it on my Twitter. It's really about people that you cannot actually quantify a person. The reason why people would not bet against Elon Musk is because he is Elon Musk. The reason why people never bet against Apple, why a $7,000 position in Apple became $3 million, the grandfather who bought in, and these are real stories, after about 20 years, from about 2003, sorry, it's not even 20 years, 2003 to about 2018. You didn't even need that Fed printing bubble or COVID pandemic. People like to say, oh, because you made money, because there was this Fed printing. No, Apple created wealth because there was mobile phones. There was real disruption in the communication industry. I mean, you're using your Apple today, aren't you? So, I mean, technology, it was very, there's a lot of secular pieces about it, obviously, atoms versus bytes. And that's the thing. You cannot really quantify people. The primary reason why I've looked and invested in Palantir as a long-term position has nothing to do with whether are they growing their commercial revenues? Are they growing those government contracts? Sure, those are fine and great. But I think the core question is the product great? Because that always is the question and the answer for almost every innovative company out there. The product was better, 10x better, and that was the P30L 0 to 1. If you had a significant 10x edge over any product out there, you do not need any marketing. You would monopolize the entire industry. And that's how he bought $5 million on Facebook, which is until today, what, $400 billion? And it's probably going to hit trillions, even if a lot of people say, oh, but Zuckerberg, he is having all of his army of followers. I've seen a lot of opinion and data and against him. You could say, hey, you're just talking about fan base here, fandoms. Not really. You look at the historical track records. You look at even before Elon Musk built Tesla and SpaceX, he was already PayPal mafia. And even before PayPal, he already created those games. So, I mean, do you know that the Palantir has 170 ex-alumni founders? And these people who work end up finding a solution to a problem, ending up starting their companies. So instead of these engineers going to an MBA, they decide to go tour a Palantir and work there. So the smartest people are hired, which is similar to what happened to Google and Facebook around year 2005. 2005, it was Google. 2010, 2009, it was mostly people wanting to work away from Google and towards Facebook. They followed where Sheryl Sandberg went. If you were like maybe graduating year 2005, I guess you would say, I want to work for Google. And maybe if you graduated somewhere about 2009 or 2007, 2008, you would have wanted perhaps to work for a Facebook. And maybe in around 2008 to 2010, you probably wanted to work for a Tesla. And nowadays, 2020 to 2022, a lot of people wants to work for Palantir. And you ask yourself why? Why would these software engineers want to work for a Palantir? And you also ask yourself, why are the top talented engineers from Apple and Facebook leaving and they are going towards other climate change industries, biotech industries? They started some battery EVs, electric vehicles. Some of them, like J.M. Straubel, went on to start his own recycling firm for which is Redwood. And you've got companies also involved today in artificial intelligence, people branching away from Google. They created DeepMind. Well, DeepMind is still in Google X Ventures. So I think that there's a lot of credence for the Silicon Valley people who do not even look at those numbers. Instead, they look at the products. Instead, they look at the founders. And this has always been true. Skin in the game. There's no other person here today at age 38, a big tech, that's Facebook, Zuckerberg. And he is wildly underestimated today as an underdog. And this also happened, by the way, in 2015 for Nike. There was a time, because Kanye West was very strong on his Yeezy Boost on Adidas, that Nike lost market share. 5-0. 50% down for Nike. Who would have thought? $100 Nike going down $50. That was 2015. Obviously, it had a culture of ownership, and these people would not destroy Nike brand forever. There was a perception that they were losing, but they were not. Fundamentally, they weren't. And today, there's a perception that Airbnb is losing, Booking is losing, Disney is losing. That's a perception. Look at the actual numbers. They are not dead. In fact, the fundamentals is really growing. So, of course, you need a little, I think you need a lot of ideas, but also you try to really sift out all the noise. It's just too much people who cannot see that the business is composed of people and their skin in the game. It's people and their skin in the game, after all, founder-led. So I really don't like banks, sorry, even if banks are great dividend plays. There's other energy names that can do that for you, shale or shipping. A few mining, yes, maybe, not all, but it's cyclical, obviously. So this is a great article about the unicorn ranks of all these people who worked for Palantir and then ended up working on their own companies and founding them. AI Startup Arena, Web3 Developer Kurtosis, OpenSea, Hex, Amplitude, Affirm. Those are just a few. And these are opportunities. And let me just read to you a few things. There are opportunities that are being missed because of the inherent biases we hold. That's true. So we have the inherent bias that growth stocks are bad, dividend income stocks are boring.
Good afternoon, everybody. I'm Anton Sorkin.
And people who don't care about shareholders, like Alex Karp and Elon Musk. I mean, have you ever tried listening to an earnings call by these guys? They hate Wall Street. Once upon a time, Jeff Bezos said, if you're gonna deal with me on quarterly earnings misses and estimates and consensus expectations, to hell with you. Seriously, these guys don't care. They don't give an F. I'm not saying that they are disrespectful to Wall Street, but at some point in time, you don't expect a business to just keep on growing like a straight line, because these are not consumer staples. Obviously, they are cyclical. You know, there are companies that are suddenly spiking 100 to 500% growth, and then their growth will plateau. Just like what happened to Zoom Video. Their revenues went from $89 million to $5 billion in 3 years, $4.5 billion, if you want to be very nitty-gritty about it. 4.5 billion. Have you ever seen a company go 45x in revenues in just 3 years' time? It's very rare, to be fair. Very, very rare. So I think like that's just my personal criteria. Like you cannot really just look at those overrated metrics, nor the seasonality indices. So I share to you this one, the Halloween effect. So the Halloween effect is like a rule that some people believe that every November, apparently all the way till about November until April, supposedly the Halloween effect means that you would have a greater return versus May to October. So apparently, May, June, July, August, September, October is supposedly bad. Well, that's fun. November till May, June, November 2021 to June 2022 was obviously bad because the market hiked rates and that precipitated all the way towards shorting the entire market. So that Halloween effect obviously didn't work out the last 7 months. Why should I believe that the next 7 months is going to work? And do you know that there are like reams of studies historically about Tuesdays being great, up days, Fridays being weekdays, very, very weekdays on a Friday, supposedly, because of behaviors. To me, all I could say to you is that these are tendencies. These are tendencies, and our brains are our worst enemies. So they say that there is apophenia. Apophenia is to suffer from patternicity because seasons or charts or fundamentals give people an ideal time to buy or sell. So chartists, others believes in the 61.8 Fibonacci, 78.6, 88.5 percentage. There's a particular indicator, McClellan oscillator. And then there are people who refuse to time the markets like Motley Fools or Buffett. It is not to say that they shun technicians, but I think what they're saying is that to simply believe in a holy grail on charts is not right. So there's like armies of people with numbers and realities. So all I can tell you is the following things. The deception of charts or seasons is playing a real trick on us. That we human beings can support the bias that we have already established. We're just simply confirming our bias. If I tell you that the coin flip would often have a 65% possibility of landing into heads every Monday and a 35% possibility of landing into tails, for some reason, the wind or the climate change, apparently, will you ever bet 65% towards that edge, that little edge? So because of that little edge, a lot of people try to time the market, and that is the deception. The deception there is really our overconfidence. What Morgan Housel's Psychology of Money really said is the reason why Ronald Read really made a lot of money was, number one, he stuck to dividend income, which is what his forte was. Just like Buffett, he does not deal too much with esoteric names. That's why him going out of his comfort zone just to buy a huge chunk of Apple during 2013 was already a milestone step for him. He was 83 years old when he decided to buy Apple. So this is really a topic to discuss for people who are always growth investing, and also a topic for people who are only trading or people who are just pure investors, who are just index spy players. You'd learn from several people that while diversification makes sense, at some point in time, you have to decide if you believe in a certain trend, and that's what some Tesla people did, and that's what some people who believe in Bitcoin did. It does not take a big amount of your net worth. $300 a month is enough. $500 in a month is enough. So if you believe, for example, let's say I believe in Shopify and Palantir. I'm not going to get those chartists to tell me, Nikki, you're wrong, because Shopify will do this, because the indicators are going to do that. At some point, I deal with the risk. I'm okay with that risk exposure. I placed $500 on Disney, and I don't care if it rots to $100 or $105 or goes $150. People avoid pain a lot. The pain of not knowing the market bottom, the pain of not knowing the top of the market bottom. All of those are painful experiences. And the pain also of omitting, the mistake of omission. People are fearful of missing out because what if Palantir actually goes 10x over the next 10 years and they do not do a single $500 per month share today while it's $7.50? So I look at these things that all of these are really about your psychology. It's about your own psychology. So I'll just give you a few things that I know. You can learn from everyone, including technicians. So for technicians, they only believe in a few things. Trends will correct via price or time. And in price, unwinding of a dot-com bubble, even if you are not knowledgeable about this, the price usually will drop 80% from the peak, which a lot of companies on the growth names already did. So it already fell, most of them fell 80% already. So in terms of hitting oversold levels as a group, we, in my view, a lot of technicians will also agree with this, we hit oversold levels May, June 16, 2022. So it could have been May 12 or June 16 that you are referencing about in terms of huge oversold levels. So you could correct via price or time. We decided to plunge fast so that we can just go sideways next few years. Now, a few things that you have to also contend with. If big tech like Apple is actually holding on near its peak, no matter if I myself do not believe that iPhone will grow, the shipments aren't going to grow. All the semiconductors are also saying and PC shipments are going to fall with consumer spending. But the fact that your Apple is trading, outperforming your SPY and your NASDAQ, at some point, if Apple actually holds that strength into the end of this year, growth stocks might actually find their footing relative to value stocks sooner than later. Take note that today, everyone believes that value is the way to go. And people have shunned growth stocks. But as technicians, we think that growth stocks have actually hit oversold levels, hit a rebound, and are simply retesting today. So rebounding was finished until August 16. Today, we're just retesting, which is so far a September 1 retest. And this is the final play for the bottom to finish, the breath trust. The breath trust is to trigger all sectors to go up. That fourth stage has not happened. Today, we're just in stage 3 of a bottoming process. Stage 3 is just retest. So you're already seeing some outperformers. Leaders like Enphase is just in a retest phase. Leaders like Sunrun are in a retest phase. You've got higher lows, obviously. You've got uraniums hitting a leadership role here. You've got companies like CellH, the Trade Desk, hitting some leadership roles. The point here is that these companies are unlikely to hit oversold levels yet again, at least so far from a technician's rule book. Not all technician rules are guaranteed, but there is obviously a high edge, and those small edges accrue over time. So to finally, all of this topic that I just discussed, what's my, what am I looking at? I'm looking at this part wherein for a successful retest, go look for positive divergences, fewer sectors and stocks making new lows, as well as less total volume and less downside volume. Because a failed retest would include new lows, more downside volume, and more resets, and the bottoming process will come back to step 1, meaning we haven't hit the oversold level, it was a bear market rally, and it's going to be a deeper drop. The breath trust, which is step 4, is the early stage of the sustained uptrend. This is really the call out of a bull market in place, including most stocks rallying together, If a few industries will falter, plenty of others will support the popular averages. So today, we are at step 3. So far, we are at step 3. A few companies are not anymore hitting new lows, so that's a good thing. And one thing that I've noticed is that biotech, if you've been looking at the charts, XBI is going up, ARCG is going up, a lot of biotech and genomics, and even China, for God's sakes, China's rising. So, I mean, your Futu and Pintuoto is up massively since March. All that your Alibabas are doing is sideways, triple bottoms, quadruple bottoms. It's not going to outperform, but the fact that it's not hitting new lows is a sign that it is bottoming out. It's just a longer time of bottoming out processes. Your Facebook, aka Meta, did not break down to new lows. 157 held. Your Netflix, even after losing 1 million subscribers, did not break down at $160. What do you call that? That is a bottoming out process. A lot of companies like Affirm and Upstart are not hitting new lows. Affirm's low was 13. Now it's what? 23, 22. Even in a bad climate. So you have to think about these facts. These are evidences. When people say it's gonna retest new lows, let's watch the evidence first. Playbook-wise, financials are actually higher lows. Even JP Morgan is a higher low. Even Goldman Sachs saying that there's doom and gloom, 50% lower net income, laying off people because of high interest rates, they're actually quite high. I mean, it's just what? JP Morgan is what? 170 to 113. Your Goldman Sachs is 400 to 330. It rallied from 283. You've got payment Visa volumes doing well, and it's actually consolidating nicely here at 200. It could rally back towards all-time highs to $250. I could name a lot of names that are showing me strength. It's just going to take me a few months maybe to prove that, okay, time's up. All your concerns about the Armageddon are not happening. So I want to end this long speech with a few things. Let's share a few things that successful technicians like to share. I love to learn from other people. This comes from Bob Farrell. He said 10 market rules to remember. Farrell's rules are relevant. This is shared by a lot of CMTs, Chartered Market Technicians. He retired from Merrill Lynch. Rule number 1, markets tend to return to the mean over time. I.e., if you are oversold, indeed, some companies like growth stocks would return to the mean over time. If it's down 80%, 95%, or even worse, as long as the company's businesses are fine, it will return to the mean. Excesses in one direction will lead to an opposite excess in the other direction. Although today there is strength in a lot of the dollar, could it be that the dollar strength is way too much as well? Number 3, rule 3, there are no new eras. Excesses are never permanent. That just goes to tell us that excesses, even in EV, like the Tesla, had to fall 50% just to trim the froth, right? In the short term, it had to happen. It was a healthy pullback. Big tech had to correct. NASDAQ had to correct. But it was a healthy pullback. Exponential, rapidly rising or falling markets usually go further than you think. But they do not correct by going sideways. What it only means, rule number 4, is if you went 10x or 30x or 15x like what Bitcoin did, you obviously would have to correct farther than what people think. It's not going to correct sideways. Bitcoin had to drop 70% from its peak. It could even drop 80% or 90%, just like what happened with Coinbase, which was overinflated to begin with. Number 5 rule, the public buys the most at the top and the least of the bottom. Ask everyone around you, is there a ton of pessimists? That pessimist isn't buying yet. That's why the public usually do not buy a lot during the bottoms. Fear and greed are stronger than long-term resolve. What this only means is that the long-term resolution for inflation expectations to be below 2%, in my view, is baloney. Because fear and greed is always going to be there in the market. If companies can tune a 15-20% return on those growth names, and they can make something like 10% consistently on dividend names on a few, fear and greed would be there in the first place in the market. Markets are strongest when they're broad, weakest when they're narrow to a handful of blue chip names. Right now, we are seeing that the markets are quite broad based. Even if you argue that growth stocks were shunned, growth stocks managed to rise 50, 100%, some of them since the June lows. Some of them even rose since March, such as Enphase. What do you call Enphase? A solar company? Well, that is a growth name. Enphase, Solar Edge are growth names. Your Sunrun, SunPowers are also growth names. A lot of your uranium companies are growth names like CCJ. CellH is obviously a growth name. Bear markets have 3 stages: sharp down, reflexive rebound, and a drawn-out fundamental downtrend. So bear markets often are said to be long, but 3 stages. The sharp down already happened. The reflexive rebound also happened. Now we are in the drawn-out fundamental downtrend, which can last to a sideways either 6 months, a year, or 2 years. But that's where we are. Shopify is trading between 30 to 45 for over 4 months. Was it 4 months or 3 months or 2 months? But it's like a long drawn out sideways play. Rule number 9. When all the experts and forecasts agree, something else is going to happen. A lot of the consensus today thinks that, okay, the market is going to hit downwards and downwards and downwards and hit new lows. And that's why it doesn't really happen. Rule number 10. Bull markets are often more fun than bear markets. Everyone knows that. Bull markets, in reality, in a year, if bear markets would last a year, on average, bull markets usually last 3 years. So whether we start our bull market in 2023 or 2024 or 2025, you've got about 3 years of happiness yet again. So quite a few things to remember. So that's about it. I know that I talked a lot. Thanks for watching. And I do want you to listen and learn from real people. I think Ronald Reed, no matter if he's dead, I looked at his dead portfolio. I mean, he's a dead man. His portfolio, in my view, has done very well this year. Dividend stocks this year did well because it was a timeless concept. I think it's because it's timeless. People all throughout the world love cash. And if you're a company that prints cash, people would buy you. Even if you're just a simple McDonald's, even if you're just a simple Nike that everyone shuns today, Nike's at $100, Starbucks at about, Starbucks I wouldn't pay up today, but I'll wait at about 60 to 70 people would start buying it back. You have to think about what type of investor are you. So barbell personality works. And then also remember, you want a 10x in a decade, right? So you cannot actually just go 100% all in dividend stocks. Neither should you also, and there's nothing wrong if you are a growth investor per se, because the growth investor breed are the Silicon Valley breed. That's the reason why I would always defend the bubble. No matter if people say you're defending bubbles, you're defending high unprofitable growth companies, Square has not made a profit. That's not true. Square just kept on reinvesting. These companies were profitable. C Limited was profitable. They just had to grow a lot of those fulfillment centers. And nowadays, they hired too much. They're spending $2 billion per quarter on operating expenses and G&A and R&D that probably is not going to make money soon. So what did they do? They laid off those people. So they're going to save about $400, $500 million in terms of operating expenses. Yeah, so I think like it's always just a balance. There's nothing wrong about a playbook for your life, because what I've learned, and this is what I really learned, and this is what I tell every Awesome 10X system. I know I talk a lot. Sorry for that. Concepts, and these are very important. Pizza pie rule, I really adhere to that. Prepare the ark, do not predict the rain. Even if cash is zero, who cares? Because someday you have the cash, you can buy the opportunities like what's happening now. But really, the awesome Tenets system believes that you and I are fucked up individuals, that we are not spreadsheets. We don't follow consistent games because obviously we are human beings. We are fucked up individuals who would want to consistently buy, but we intensify a few names if we wish, right? So this is really, wait up. This is the rule. This is really my ending rule. The awesome Tenets system, which is really like an experience-based system that I've crafted for myself, which I'm just sharing to all of you. It believes that you are not a spreadsheet. You are a person. You are a screwed up emotional person. You are the most important risk that we have to manage. When I say you, I'm also talking about myself. So I am not a spreadsheet. I am a person. I am a screwed up emotional person. I am the most important risk that I have to manage. I look at my mirror. I look at myself. That's my risk, myself. I will sell when I shouldn't. I will systematically underestimate my risk. I will wipe myself out if I do not cost average and sleep. Or at the very least, if I don't do the pizza pie rule of asset allocation game. When I should be buying the stock, I would go haywire and go crazy about the fact that maybe it falls next week. I am my own problem. So to protect yourself from yourself, we must imagine an automated cost average system, or the way that real estate made people forced savers. Just monthly, you're amortizing it, right? And you can never sell it because for the next 10 years, that property, you have to hold on to it, right? You can't flip that house. Well, usually. So the awesome Tenets system is a plan, knowing you and I do not have a plan. If we know that we cannot stick to our plan, that we cannot diet, the only way for us to be wealthy long term is we obviously have to save 25% saving rate per month in our IBKR or in our Webull or in our eToro accounts. We have to have that 25% every month like an unlimited ammunition gun. That's what made Warren Buffett wealthy. That's what Ronald Read had. He only had $300 per month, but he had consistency because he automated it in the first place. By design, you set it up, $300, $1,000, $500, whatever it means, decide how much you want to risk for your ruin or your long-term life, right? Automate is more important than discipline. I've always believed that. I wake up, I always have to automatically brush my teeth. I always have to automatically take a bath. I don't need to think about it. It's automatic. So financial discipline for freedom, automatically wealthy, it just has to be integrated in your life. You are a product of your environment, not of habits. If your entire environment is all eating great food, how can you expect to be really, really thin? I mean, you're going to eat salads when everyone's like eating steak, diba? Design is how you set things up. If your environment has already been set up for success, you would have an easier time to succeed. Change your environment so that you change your mindset. Obviously, if you want to be wealthy, you got to listen to people who have been doing it, who are practicing that, wow, $300 per month. I'm going to buy Disney no matter what, no matter what, no matter what. Invest with discipline, money should follow. So really, it's easier said than done, obviously. But that is really the way that we have seen the people who already made it, did it. Ordinary people, but extraordinary consistency. It sounds easy. How many ordinary people can consistently walk 10,000 steps a day? They say that if you walk 10,000 steps a day, automatically you would have been thin anyway. If you consistently just stop eating 6 p.m., i.e. intermittent fasting every day, You would not have heart diseases, all of those health-related problems. Those seem easy, right? Easy, consistency. I believe that's not easy. If that were true, there would have been no job for the people addressing diabetics, which is what Dexcom, a stock who provides diabetic patient solutions, they would not have gone more than 50x, i.e., they would not have had clients. There's so many people who say consistently cost average, consistently cost average. That's not true. I am a broker. I have clients. You tell them to cost average in a recession, they would not. I'm sorry, I have exposure. So I know for a fact that we are screwed up individuals. And that's the reason why the contrarian way of investing in recessions habitually over the last few centuries have always worked. That's why only abnormal people, you are abnormal. The fact that you're investing in a recession, the fact that you're watching this show, the fact that people will say, who the hell will spend time to watch this girl rant about investing in a recession? That makes you crazy. And being crazy changes the world. That's what Apple said. Apple said, think different. The people had to be crazy enough to believe that EV is going to work. Electric vehicles, is that going to work? Today, eVTOL, is that going to work? Electric vehicle takeoff landing. I like Lilium, but if I have more money, I'd try to park it there. Archer Aviation as well. At some point in time, the truth is, the people who do not need the money make the money. That's always the truth. Why? The people who do not need the money make the money because every month they have a cash flow. They have a stable job. It is a recession, but they have a stable job. The hell, they are the best lawyer in town. They're the best surgeon in town, the best teacher in town, the best businessman in town. They've got plenty of real estate out there. They would have incomes no matter what. They're just sleeping, lying around, and they have income. You do not really need to work so hard. But maybe you have to work so hard first on your first $100,000. But after that, I think it's really more about how are you allocating your wealth? Do you have like 5% in cash or 50% in cash? That's not bad. At least you are saving money, right? Because that money, you could probably buy a great house and you can probably buy a great asset like a Google now. You can probably buy a Disney now, a big high quality tech at a discount. So that cash is important. Had you not had cash and then you get sick, what? You're going to borrow money? You're going to ask your friends? You're going to ask your family? If you do not have a job, what's going to happen? The stability of cash flows automatically stops. And when you don't have the stability of cash flows, that's the hard thing. Even if you wanted to, and I would surmise, a lot of people would probably want to invest in recessions. It's not that they're crazy. They are not crazy enough not to invest in a recession. They just don't have the cash. They are having a tight problem with inflation. They don't have enough resources. They happen to be in a business that isn't making a lot of money. So what could you do if you are stuck in a job that isn't going to promote you or something, or something like that? So there's a lot of reasons why normal people cannot do the consistent cost averaging. I think there's a lot of reasons why. They just have no predictable income that comes in every month. And to make that predictable income come, that's the rule number one. You need to invest in yourself and your skill. The only way for people to give you money is you have a job or you have a business. People would have to pay you for the value you give them. And that's the only way for that consistent cash flows to come. And then when those consistent cash flows come, that's when you spread it out towards businesses that you believe upon. Because that's really how things are. Yun, sorry, I really talk a lot. Yeah, sounds like a rant, no? But I really, really just believe that these are the precepts of long-term wealth creation. And I just wanted to share most of that because that's just what I wanted to talk about. Didn't want to talk about charts or anything. I could go on and on and on, but that's really how I am now. Bye-bye.